Everyone says SCHD is a safe, set-it-and-forget-it investment, but that's not the full story. Yes, SCHD is an excellent dividend ETF, but if you blindly invest in it without a strategy, you could be leaving massive returns on the table or even hurting your financial future. Most investors assume that because SCHD pays high dividends and has a strong track record, they don't need to do anything else. But that mindset can lead to costly mistakes. Mistakes that could slow your portfolio's growth, limit your passive income, and put you behind on your financial goals. In this video, we'll break down the 10 biggest mistakes people make with SCHD and why most investors are using it wrong. I'll show you how you can avoid all these, and in the end, I'll show you how much daily investment, spoiler alert, it's in single digits, you need to retire with a portfolio close to $1 million that pays over $70,000 in annual dividends, which equates to over $5,000 in monthly dividend income. Before that, let's start with one of the biggest mistakes investors make when it comes to SCHD, and that is getting overly excited about its high dividend yield. At first, it seems like free money. After all, SCHD offers a yield of 3.55%, which is 27.75% higher than the median yield of other ETFs at 2.78%. That sounds fantastic, right? But here's the catch. Focusing only on dividend yield can lead you down the wrong path. A high yield might look attractive in the short term, but it doesn't always mean the investment is solid in the long run. When investors chase high yields, they often ignore an equally important factor: dividend sustainability. Just because a company or fund offers a high dividend today doesn't mean it'll continue to do so in the future. Companies in SCHD might face economic challenges, and if they struggle financially, they could cut or reduce their dividends. This would not only decrease your income, but also hurt the value of your investment. Another common mistake is ignoring dividend growth. Many people get so focused on the current yield that they forget to consider whether those dividends are actually growing. Luckily, SCHD shines when it comes to dividend growth. Its dividend growth rate for the last year is 12.23%, compared to the median ETF's 7.74%. Over the past 5 years, SCHD's dividends have grown at an impressive 11.59% CAGR, while the average ETF only manages 4.77%. So while SCHD's yield is strong, the real value lies in how consistently those dividends grow over time. Let's put it into perspective. Imagine you earn $100 in dividends this year. If your dividends grow at 11.59% annually, you'll be earning around $170 in just 5 years. But if you're only focused on the high yield and ignore growth, you might end up stuck with a fund that pays a lot now but doesn't increase over time. Over the long run, growing dividends can give you much more income than a flat, high-yielding dividend. So, mistake number 1 was all about chasing high yields without considering sustainability. But here's an even bigger risk: believing SCHD is a completely safe investment. That false sense of security can cost you thousands. Just because a stock or ETF pays dividends doesn't mean it's immune to market downturns. Companies can face tough times, and if their profits fall, they might reduce or stop paying dividends altogether. SCHD has a strong history. It's grown its dividends for 13 consecutive years, which is far better than the average ETF that manages just 1 year of growth. But even with this strong record, markets can change, and assuming SCHD is completely safe is a risky mindset. Even if you understand SCHD isn't risk-free, many investors still fall into a dangerous trap trying to time the market instead of sticking to a proven strategy. This mistake leads to lower returns and missed opportunities. This means they attempt to guess the perfect time to buy or sell, thinking they can snag shares at the lowest price and sell at the peak. It sounds like a smart strategy, but the truth is even professional investors struggle to predict the market consistently. More often than not, trying to time the market leads to missed opportunities and lower overall returns. So instead of trying to predict market movements, a better approach is to invest consistently over time. This means contributing to your SCHD investment regularly, whether it's monthly, quarterly, or with every paycheck, regardless of what the market is doing. This strategy is known as dollar cost averaging. When prices are low, your money buys more shares, and when prices are high, it buys fewer. Over time, this averages out your purchase price, reducing the risk of making a big investment at the wrong time. Okay, so you now know that timing the market is a losing game, but what if I told you that one simple decision, reinvesting your dividends, could grow your portfolio nearly 5 times more than just collecting payouts? Most investors ignore this, and they pay the price. While it might feel rewarding to receive regular cash payouts from dividends, simply letting that money sit in your account or spending it means you're missing out on one of the most powerful tools in investing, which is compounding. Reinvesting dividends means using the income from those payouts to buy more shares of SCHD. Over time, these additional shares also generate dividends, creating a snowball effect where your investment grows exponentially. Let's break this down with some real numbers. Suppose you invest $10,000 in SCHD and decide not to reinvest your dividends. After 30 years, your portfolio would grow to around $97,056. That's still a decent return, but here's where the magic of reinvesting dividends comes in. If you reinvested those dividends instead of taking them as cash, your $10,000 would grow to an impressive $464,215 after the same 30 years. That's almost 5 times more wealth, all thanks to the power of reinvesting. Why is there such a huge difference? Well, it's because each time you reinvest your dividends, you're buying more shares of SCHD. These new shares then start earning dividends as well, and over time, this cycle repeats itself, accelerating your portfolio's growth. Without reinvesting, you're only earning dividends on your original shares. But with reinvestment, your dividends are constantly working for you, helping your investment grow much faster. Now, in the end, I will show you how to use this strategy to invest just what a daily coffee costs and retire with a portfolio close to $1 million that pays over $5,000 in monthly dividend income. Okay, so we've seen how important it is to keep your dividends working for you. Let's move on to another mistake that can trip up even experienced investors: ignoring SCHD's underlying holdings. One of the biggest mistakes people make when investing in SCHD is not paying attention to what's actually inside the fund. SCHD is an ETF, which means it holds a collection of different stocks, but that doesn't mean it's automatically diversified the way you might think. Many investors assume that buying an ETF like SCHD spreads their risk across all sectors evenly, but that's not always the case. Without understanding the specific companies and sectors SCHD is invested in, you could be exposing yourself to risks you didn't even realize. For example, SCHD is heavily weighted in certain sectors. Financials make up 18.85% of the fund, and industrials account for 11.35%. This means if there's a downturn in the financial sector, like a banking crisis, SCHD could take a bigger hit than other ETFs that are more evenly spread across different sectors. The same goes for industrials. If the economy slows down and companies cut back on building and manufacturing, SCHD's industrial holdings could suffer, dragging down the entire fund. Failing to understand the underlying holdings means you're investing blindly. You might think you're diversified because SCHD holds over 100 companies, but if many of those companies are in the same sectors, you're not as diversified as you think. And that leads to the next common mistake: not diversifying beyond SCHD. While SCHD is a solid fund with a strong focus on dividend-paying companies, relying solely on it can limit your investment potential. A lot of people fall into the trap of thinking that because SCHD holds over 100 companies, they're fully diversified. But here's the thing: SCHD only invests in U.S. companies that pay dividends. That means you're missing out on other important areas of the market, like international stocks or high-growth technology companies that don't pay dividends. For example, SCHD has only 10.22% of its holdings in the technology sector. But technology is one of the fastest growing sectors in the world. Companies like Amazon and Google, which are major drivers of market growth, don't pay dividends, so they're not included in SCHD. If you only invest in SCHD, you could miss out on the massive growth potential of these types of companies. So a good rule of thumb is you also add a couple of solid stocks alongside SCHD to your portfolio. But even if you diversify, there's still another factor many investors overlook. A mistake that flies under the radar for many SCHD investors is ignoring the fund's rebalancing schedule. Rebalancing is when the fund adjusts its holdings to stay aligned with its investment strategy. SCHD rebalances quarterly, which means every 3 months the fund makes changes by selling some stocks and buying others based on specific criteria. Why does this matter? Well, if you're not paying attention, these changes can catch you off guard. For example, a company you really liked that was in SCHD might get removed if it no longer meets the fund's standards for dividend growth or financial stability. On the flip side, SCHD might add a company you didn't expect, which could shift the fund's sector exposure or risk profile. SCHD doesn't just make random changes during its quarterly rebalancing, it follows a specific set of rules to ensure it continues to meet its investment objectives. Here's how it works. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which is made up of 100 high-quality U.S. companies with strong dividend-paying histories. To stay in the fund, companies must meet 3 criteria. Companies must have consistently paid dividends for at least 10 consecutive years. Companies are evaluated based on financial metrics like return on equity, dividend yield, dividend growth rate, and free cash flow to debt ratio. Lastly, the fund looks for companies that are not only paying dividends but are also likely to continue and grow those dividends in the future. Then every 3 months, SCHD adjusts the weight of its holdings to ensure no single company dominates the fund. This helps maintain diversification and reduces risk. And once a year, the fund does a deep review of its entire portfolio, removing companies that no longer meet its strict criteria and adding new companies that qualify. This is when you'll see the most significant changes in the fund's composition. Also, SCHD ensures that no single sector dominates the fund. This prevents overexposure to industries that might be performing well now but could face downturns in the future. For example, no single sector can make up more than 25% of the total fund, and no individual stock can exceed 4 or 4.5% of the portfolio at the time of rebalancing. While SCHD is focused on dividend yield, it doesn't just chase the highest yielding stocks, it also screens for quality, meaning companies must show strong financial health and the ability to sustain their dividends over time. This balance between yield and quality helps reduce the risk of investing in companies that might cut their dividends in the future. Ignoring these rebalancing changes can lead to surprises in your portfolio. Let's say SCHD removes a company that paid a large dividend. You might notice that your dividend income drops, and if you weren't aware of the rebalancing, you might not understand why. Or if SCHD adds a company with a strong growth potential but a lower dividend, your portfolio might grow faster in value, but you'll receive less income in the short term. While it's important to stay informed about SCHD's rebalancing, you also shouldn't get distracted by the excitement of individual stocks during a bull run. It's easy to feel tempted to pull your money out of SCHD when you see other stocks skyrocketing, but that short-term thinking can hurt your long-term strategy. And that brings us to the next common mistake, confusing SCHD with individual stocks. So a comment on one of our videos from one of our followers mentioned Tesla is up 32,795.31%, the trillion-dollar gorilla in the room. Look, while Tesla's explosive growth is undeniably impressive, comparing it directly to SCHD doesn't really make any sense because they're two very different types of investments. SCHD is designed to give investors exposure to a diversified basket of dividend-paying U.S. companies. This diversification helps reduce risk because your money isn't tied to the performance of just one company. If one company in the fund struggles, the other companies can help balance it out. On the other hand, buying a single stock like Tesla means you're putting all your money into a single company. And while Tesla has experienced massive growth, it's also been extremely volatile. Its price can swing wildly up or down based on news, earnings, or even Elon Musk's tweets. With individual stocks, you face the risk of losing a significant portion of your investment if something goes wrong with that specific company. Investors looking for quick, massive gains might be drawn to high-growth stocks like Tesla, but this comes with a lot of risk. SCHD, by contrast, focuses on steady growth and reliable income through dividends. It won't skyrocket like Tesla, but it also won't crash as hard during market downturns. Comparing SCHD to a stock like Tesla is like comparing a family sedan to an F1 race car. One is built for steady, safe travel, while the other is designed for speed with a higher risk of crashing. This brings us to another mistake: focusing too much on short-term performance and ignoring the long-term potential of SCHD. It's easy to get caught up in how your investment's doing this month or even this year, but SCHD is built for the long haul. If you only look at short-term returns, you might think SCHD isn't performing well compared to other investments, and that could lead you to make some poor decisions. Let's take a look at the numbers. In the last month, SCHD had a total return of 1.87%, which is just slightly below the median for all ETFs at 2.26%. Over 6 months, SCHD's total return was 2.96%, which is 21.99% lower than the median ETF. If you only looked at these numbers, you might think SCHD isn't a strong investment. But here's where many people make a mistake. They don't zoom out to see the bigger picture. Over 3 years, SCHD has a total return of 18.27%, which is 22.58% higher than the median ETF. And over 5 years, SCHD's total return is a solid 74.93%, nearly double the median return of 37.73%. This shows that while SCHD might not always shine in the short term, it delivers strong, consistent returns over time. Remember, in the end, I will show you how you can invest just what a daily coffee costs and retire with a portfolio close to $1 million that pays over $5,000 in monthly dividend income. Now, possibly the worst mistake investors make with SCHD is not adjusting their strategy as they get older. When you're young and have 30 years until retirement, you can afford to take more risks because you have plenty of time to recover from any market downturns. But as you get closer to retirement, your focus should shift from growth to preserving your wealth and generating a steady income. Let's say you want to retire with a portfolio that pays $2,000 in monthly dividend income by the time you retire. Let's break this down with SCHD. If you start investing with $10,000 at age 30 and reinvest your dividends, your portfolio could grow to $464,215 by the time you retire at age 60 and pay around $2,000 to $3,000 per month. This growth comes from a combination of capital appreciation and reinvested dividends. At this stage in life, your primary goal is to grow your money as much as possible. But if you're only 10 years from retirement and need to build enough wealth to generate $2,000 per month in retirement income, you'll need to invest more aggressively. In this case, you might start with a $200,000 investment instead of $10,000. After 10 years with dividends reinvested, your portfolio could grow to $619,568. This larger starting amount helps you catch up, but the risk is higher because you have less time to recover from any potential market dips. Now, here's a little SCHD secret for building passive income without needing a massive upfront investment. You don't have to dump thousands of dollars into the market right away. In fact, by simply investing $7 a day in SCHD, you can steadily create a reliable income stream over time. All thanks to the power of dividend growth and compounding. Let's break it down. Suppose you start with zero initial investment and commit to adding $7 every day into SCHD. Even with this small contribution, your money doesn't just sit there, it works for you. SCHD offers a solid dividend yield of 3.55% and a strong history of dividend growth with a dividend CAGR of 11.04%. These dividends can be reinvested to buy more shares, which means you're earning returns not just on your original investment, but on the growing dividends as well. After 5 years, your $7 a day investment will grow to $16,156. Fast forward to 10 years and things start getting more exciting. Your total investment will be valued at $45,211. By the 20-year mark, your passive income is becoming more noticeable. Your total investment will be valued at $208,807. After 30 years of contributing and reinvesting dividends, your portfolio would reach an impressive $938,235. You would have contributed only $76,650 out of pocket, and in return, you would get $442,328 in capital appreciation and $419,257 from reinvested dividends, adding to a total value added to your portfolio of about $861,585. Want more in dividends? Click the video on the screen to find out how to earn over $20,000 in monthly dividend income with a one-time investment.